Today we're going to be looking at myths about investing that are actually dangerous because believing them or following them actually keeps you poor, stops you from making money, and causes you to be exposed to more risk. If you don't know who I am, my name is Joe Brown, and in 2019 I quit my job in finance as a stockbroker so that I could start this, Heresy Financial, where I teach people how the economy works so that you can make more money investing. And back when I was a stockbroker, I saw a lot of these myths repeated over and over and over again because the entire financial industry is just geared to getting you to give them your money so that they can start charging you fees, not so that they can make you more money. So what I do here is to teach you how all this stuff actually works so that you can learn more, make more money for yourself. The more you learn, the more you earn. Myth number one is that you cannot time the markets, so instead you should just dollar cost average into the markets. If you're not aware, dollar cost averaging means you take the same number of dollars and you invest it at a regular frequency into the stock market. The idea is that this will allow you to capture some of the volatility. You buy more shares when the price is lower, buy fewer shares when the price is higher. The average of your cost is then lowered as a result, which increases your returns over time. The problem with this, and why I call it a myth, is because dollar cost averaging is simply just a sleight of hand because they say you do that instead of timing the market, but dollar cost averaging is actually just timing the market just over a longer time horizon. Because the built-in assumption to why dollar cost averaging would work to lower your cost and increase your returns is because the assumption is that the market will be higher in the future than it is right now. But more importantly, the assumption is that the market will be higher when you need the money in the future compared to where it is right now. Which means that even if you dollar cost average into the market, you still have to time the market, meaning you need the market to be higher than you purchased it when you actually need the money. And for most people, which is the reason why stock markets crash, the time that you need the money is the time when the markets are actually down. On top of that, this idea is dangerous because it implies that you should just buy markets and stocks at any price, regardless of value. That just because you have money at a specified date, you should purchase something and pay no attention to value, even if some of the assets you're buying are wildly overpriced. It forces people to buy bad assets at bad prices under false premises. Now, the objection to this is that you cannot know whether something is actually overpriced or underpriced. And in fact, the price is the value because the market consensus is built in and all available information is already priced in. And that brings us to myth number two, that markets are efficient. This is called the efficient market hypothesis. And it says that all available information is already priced in, meaning that you as little old investor have no edge and you're not going to be able to buy something or sell something based on timing or value that you can find that's not already priced in. The first problem with this is, well, it's just not true. And if it was true, you wouldn't have 1 to 2 day moves in stocks like GameStop that fly up 20, 50, 100% over the course of just a few hours or a few days. Buyers and sellers of all sizes, especially big money buyers and sellers, have all sorts of different reasons for getting into and getting out of different assets. These moves can actually move the prices, creating arbitrage opportunities that small investors can take advantage of, and more importantly, that have nothing to do with overall value. These inefficiencies, these discrepancies show up all over the market all the time. And the belief that markets are efficient just forces people into, again, buying bad assets at bad prices because they think there's no choice. They think it's impossible for little old me to go out there and find value, and so they don't even try. You miss out on buying assets that are undervalued and selling assets that are overvalued. Now, the objection to this is that even if you can find discrepancies in value, if you can find inefficiencies in the market, that you're not going to be able to do it reliably and consistently and big enough to actually beat the market. And so passive investing is the only way to invest, that it can't be beat and that it's the safest way to invest. Well, the first problem with this is that passive investing works only if the majority of the money in the market is actively investing. Because passive investors simply say, I have money, therefore I'm going to buy everything. And I am assuming that that will result in average returns over time, but it's only going to happen if the majority of the money in the market is actively seeking prices, where there are some money managers that are selling things they believe to be overvalued, some that are buying those same things that they believe to be undervalued. The market is coming up with a consensus price, and some passive investors are just riding on those coattails. The average returns and the prices in any market come about as a result of all the buyers and all the sellers. And so if too much money flips over to the passive side, then most of the money in the market is just buying simply because there's cash available, or more dangerously, they start selling just because they need cash, not paying attention to anything based on trends or price or value, undervalued, overvalued, anything that it has any relation to the fundamental reasons why you would ever want to buy and sell an asset. It's simply, I have money, so I'm going to buy everything regardless of how overpriced it might be, or I need money, so I'm going to sell everything regardless of how underpriced it might be. This means that the growth of passive investing is actually increasing volatility in the stock markets. That's why we've seen over the past couple of decades a rise in the frequency of flash crashes and major volatility and assets and markets moving down quickly and then back up quickly. The more money shifting over to the passive side means that, number one, you have bigger and bigger discrepancies and inefficiencies in the market that lead to more volatility, but also for people like you and I, it actually opens up opportunity for being an active investor because you can find things that are more wildly mispriced, both on the undervalued side and on the overvalued side. Common objection to this is that that only matters if you have big money, but if you're a small investor and you only have a couple $100s or a couple $1,000s a month to invest, then you're better off just riding the coattails of the entire market and passively investing. That the biggest investors have the biggest advantages. And this is actually the opposite of reality. Again, all of these myths are propaganda designed to force you to think, I need to just give my money to the big boys, to the financial advisors, to the money managers, instead of learning how to do this for myself, because they make you think that you can't do it without them. But in reality, the small investors actually have a massive advantage over the bigger investors. I'm going to show you the opposite sides of the spectrum as an extreme example so you understand what I'm saying here. On one end of the stream, imagine the person who has no money and they're just going to a garage sale. They're going to garage sales to find free stuff. They have $5 to their name, so they're looking for stuff that's $1, $2, and they're looking on eBay to see if they can sell it for $20, $30, $40. They're going on Facebook Marketplace, they're going on Craigslist, they're trying to find free stuff or very cheap stuff to flip. Now, these opportunities are out there all over the place. Like, you can easily 10x, 20x, 30x your money. It takes some work, you got to drive around, it takes time, but you can make real money doing this. And then over time, you can roll those profits into things that are bigger and more profitable to flip. Things like furniture and cars and eventually, houses, and you can scale this up. And I know this for a fact, but even if you don't scale it up, I know that you can make real money doing this, even with the low-hanging fruit, like the free stuff at garage sales, because my wife and kids did this when I first started Heresy Financial. When I quit my job as a stockbroker, it took me 1.5 years to build this business up to the point where I was making enough money just to pay the bills. And one of the ways we bought groceries was because my wife and kids, they would drive around sometimes, they would look for free stuff at garage sales, they go pick stuff up for free from Craigslist or from Facebook Marketplace, and they would flip it for more. They would sell it for more, sell it online. And that brought in at least a couple $100s every single month, enough to pay for the groceries. But the point is, if you are at the very, very small end of the spectrum right there, you can make 10, 20, 30, 40, 50x your money on flipping some of these low-hanging fruit items. But on the opposite side of the spectrum, you've got somebody like Warren Buffett, who needs to put billions of dollars into a deal. He doesn't care if you can get 50x or 100x return. There is no return that would move the needle for $100 billion if you can only put $5 or $10 into it to start. Even if that return is 1,000x, that's not going to move the needle. They're trying to move billions of dollars at a time. So when you have this massive scale, when you're trying to move billions of dollars or hundreds of millions of dollars even, you have to find larger opportunities, which means you're okay taking the smaller returns potentially if it means you can allocate a large amount of your wealth. This means that there are tons of very small opportunities to profit all over the market simply because they are too small for the big money to take advantage of. If the big money came in and tried to take advantage of all the small opportunities to profit, they would soak them all up and those profit opportunities would be gone. But the reason why they don't do that is because it doesn't move the needle for a $1 billion+ portfolio. And just like in the garage sale example I told you before, now I'm the guy putting up stuff for free on Facebook Marketplace or on Craigslist because it doesn't make sense for me to put in the time to try and sell that thing for $40 online. It makes more sense for me to spend that same amount of time making content, selling stuff where I can make thousands of dollars for 1 hour of work instead of spending that hour trying to make $40 on eBay. And so because I'm trying to allocate things in a much larger pool now, I've created arbitrage opportunities for the littler opportunities that I'm not taking advantage of anymore because it's just not worth my time or money. Same thing happens in the markets. So whether you're a day trader or an investor, all over the place, there are opportunities where simply because you don't have hundreds of millions of dollars to allocate, you actually have opportunities for larger profits than some of the big money does. All right, myth number 5 is that you can reduce your risk by diversifying. And this is a dangerous myth because the way that financial advisors and online gurus and your basic financial self-help people out there tell you to do this is to just buy index funds, because an index fund is 400 companies, 500 companies, 1,000 different companies. So they say if diversification is good, then more diversification is better. And this couldn't be farther from the truth. The way you measure true diversification is correlation. Correlation means if one thing goes up, does the other thing go up with it at the same time, or does it maybe go down? Do they have a high correlation in profits and losses with each other? And if the correlation is high, meaning they go up together and go down together, there is no true diversification. And that's exactly what's going on with most index funds. When you're invested in the S&P 500, the Russell 2000, the entire stock market, all of those stocks have an extremely high correlation because there's so much money investing in those same stocks. Every mutual fund, every 401k, every IRA, every basic money manager out there is putting the exact same money in the exact same allocation of all those same few hundred stocks. And so when everything goes up, it's because everybody's buying the same stuff. It goes up together. And when everything starts selling off, all those things start going down together. So you don't have diversification there because everything has a 1-to-1 correlation. In reality, you only need about 10 different assets to achieve true diversification as long as the correlation is low enough. And there are diminishing returns after that. You don't need 20, you don't need 200, you don't need 500 different stocks. You only need about a dozen. Again, the key though is as long as the correlation is low, which means they do not rise and fall together. And the other key about diversification here is that it cannot reduce any systemic risk. It can only reduce the risk of one asset in your portfolio negatively impacting or severely impacting your entire portfolio. So let's say you have 10 stocks that have really low correlation, they don't move up and down together, you've achieved good diversification. If one of those companies fails, maybe you lose 10% of your portfolio because you got a good split between those 10 stocks. The problem though is that diversification cannot protect you against systemic risk, which means what if there's a problem with the actual system? What if we have hyperinflation? What if there's global nuclear war? What if there's a big systemic collapse? Well, that would most likely affect all of your assets. Now, a lot of this can be mitigated by choosing better assets instead of all 10 of your assets being stocks. Maybe you have things like real estate and gold and Bitcoin and alternative assets mixed in there, and that will significantly help with reducing or at least mitigating some of that systemic risk. Myth number 6, and this is something that people are brainwashed with from a young age. As soon as kids enter school, that this is hammered into them over and over and over again, that the equation to wealth is get good grades, then get a good job, and then spend less than you earn. So grades, job, save is apparently the equation to wealth. And this couldn't be further from the truth. Number 1, the real equation is entrepreneurship plus investing equals wealth. The reality is that most jobs today, almost every single job, maybe outside of sales, you're never going to be able to make enough to be able to become wealthy. You're going to be able to make enough in a good job to feel somewhat comfortable. But in today's day and age, with inflation, interest rates, asset prices, and how the problems with that and wealth inequality are only going to be getting worse because of monetary policy and fiscal policy, there are very few jobs available today that you can actually get like as a job, a job, where you're going to be able to make enough money in order to get wealthy just from saving alone. Today, on average across America, an individual has to make about 6 figures by themselves just to feel not stressed about money anymore. I can pay the bills and I don't have to worry about paying the bills. Now add on top of that a family, and you're probably looking at, in 2024 and beyond, at least $200,000 before you feel that same level of comfort. And that's not getting wealthy. That's just, I'm not stressed about the bills anymore. When you add in saving enough in order to become wealthy just on savings alone, you're looking at multiple hundreds of thousands of dollars. The reality is you need a path to wealth that is faster than that you are not limited on your income by an employer who tells you what you can and cannot make, by a boss who is somewhat threatened by the fact that you're way better than they are, yet you've only been in the position for a couple months. So he just says, be patient, you'll get there someday. It's like, no, I'm much better at this than you. I should be doing a much bigger job and making much more money. I don't want my income to be limited by the insecurities of those people who have come before me. I just want to be able to be rewarded for the merit of my own work. And if I'm not good enough, I'm not gonna make enough, which means I just have to get better. And I appreciate that because now I know exactly what I need to do. And that's why entrepreneurship, starting a side business and eventually doing it as your main business, is going to be the most effective way to be able to become wealthy in the future, because your income is determined only by you, your skills, and your customers. But it doesn't stop there. I said entrepreneurship plus investing is the equation to wealth, because most people think all you have to do is spend less than you earn. But if you just save, then your money will be eroded over time due to inflation. You're not going to make any money off of that. I know a lot of people who are decently high income earners, and they have $50,000, $100,000, $150,000 just sitting in their checking account. And it's been that way for a couple of years. And guess what? They could have bought a lot more with that $100,000 a couple of years ago than they can now, because inflation is going to continue. It has been continuing and it will continue far into the future. We're in a higher for longer environment with inflation and interest rates, and that's not going away anytime soon. You've got to make your money make money for you and not just sit there and watch it get eaten away by inflation. You have to invest. You have to buy assets that start putting money in your pocket instead of watching the government take money out of your pocket through inflation. Investing myth number 7, and this is one that is really keeping people poor, is that options are risky. If you don't know what options are, they are contracts. They are contracts that give you the right or the obligation to buy or sell something like a stock. And so the reason why people think options are risky is because if you use them wrong, you actually can lose a lot of money. So I usually use the analogy of a kitchen knife. If you put a kitchen knife in the hands of a toddler, yeah, it can be very dangerous. They don't have the skills to use that knife appropriately. But if you put that knife in the hands of a skilled chef, they're just gonna chop up some cucumbers. It's not dangerous at all. It's gonna be used for its purpose. And it's gonna help get the job done better. And this is why I go so deep into this and hit options so hard in Heresy Financial University. That's my paid membership program where I teach you literally everything you need to know about how to make more money trading, make more money investing, how to make your wealth grow for you, how to protect your wealth, protect it against crashes. Options are one of the best tools for being able to do this, because when you know how to use them, you can actually reduce your risk with them. Because for the average person, you're going to invest in the S&P 500 and you're just going to hope that it doesn't crash. And if it crashes, there's nothing you can do. You're just going to have to pile more money in, hope you don't need it at the time that it crashes, and hope that someday it comes back and that it's worth more when you need it someday. But to the savvy investor who has put the time and the effort in to learn how some of this stuff works, you can implement some basic option strategies and guarantee that you don't lose money on that stock. You can simply purchase a contract called a put that gives you the guarantee that you will be able to sell those stocks at a specific price anytime in between now and when that contract expires. Which means that if the stock market crashes in between then and now, you don't have to worry. You can sell it up here even though it's trading down here. You can think of it like fire insurance on your investment portfolio. And the best part is, when you're able to do this, not only do you preserve all of your purchasing power and your portfolio's wealth, but also when you sell it up at that higher price by exercising your rights, you can take that cash, you can reinvest that money in the market at those lower crash prices and then create way more wealth on the way back up. This is why options are not risky. In fact, when you know how to use options, not only do they help you eliminate risk in your portfolio, but they can be massively beneficial tools to help you exponentially grow your wealth over time. And I do have quite a bit of training material on that in Heresy Financial University. So if you're interested in learning how to use those effectively and not using them the wrong way, check out the link in the description below. Myth number 8 is that you cannot have infinite growth with finite resources. This is a myth that has been pushed propaganda for decades now. One of the biggest ways it was popularized was back in the 60s when there was a big push saying that the world was going to run out of food because we were going to have a population explosion and we simply wouldn't be able to produce enough food for everybody, and then everybody was going to starve to death and the entire Earth's population was going to collapse. Well, clearly that never happened. And clearly we don't have more resources now than we used to. We still have the same old Earth that we always have. Yet somehow we're able to support 8 billion people on Earth today, whereas for all of human history, maybe there was a couple million people living at the same time, or a couple 100 million. Same resources, same planet, but insane exponential growth. How is this possible? Well, it comes down to the definition of growth. And this is what most people don't understand. The definition of growth is getting more for less. I'm going to say that again. The definition of growth is getting more with less. Despite the fact that we have the same resources, we have the same available farmland today that we always have throughout all of world history, we're getting way more out of the exact same amount of resources. And it's not just food. This is how literally everything works. When you look at the power built into today's iPhone versus the original iPhone, we've got the same amount of resources, but we're able to get a lot more out of those resources. We could take it back even farther. Look at the materials in here. This is literally lightning that's been shoved into rocks. That's what technology is. That's what computer chips are. Lightning shoved into rocks. Same resources, way more output. And in reality, even if you take away that definition and you just look at the amount of resources that we have available to us, for all intents and purposes, we do have unlimited resources. The bottleneck is not the resources. The bottleneck is accessing the resources and then utilizing them in a way that is cost effective. And I'll give you an example of this. If you go back thousands of years, the best real estate available was hunting grounds. That was where all people lived, was where there was enough animal population in order to be hunted to support the people there. That meant that all of the land on Earth that was not good hunting ground was not able to support human life. That land existed, but it wasn't the resource itself that was the bottleneck. It was using it in a way that is cost effective to support what we need. Now, if you fast forward from hunter-gatherer time to the agricultural revolution, that unlocked a lot of land on Earth for humans to inhabit because suddenly we were able to use land that wasn't good for hunting, but it was good for farming. Land with rich soil, good rain, land that was large and flat enough, which took a resource that was previously unusable and now became very usable and allowed a lot of growth. Fast forward from there to the Industrial Revolution, and now we need a lot of land that is hard, that we can build factories on, we can build cities on. Land that is near the agricultural land, but not the same land as the agricultural land. Again, the progress and the innovation and the technology unlocked a resource that used to be unusable, uninhabitable for man, and now it is inhabitable and it is usable and it is profitable for us. And if we push that out even farther to where we are right now, given the rise of video communication and technology and global internet, we are now experiencing the next phase of that, where we are unlocking the usability of a lot of other land on Earth for people to inhabit just to live, because we don't need to live near where we work anymore. It unlocks a lot of beautiful land for people to live and use for enjoyment that previously was unusable, because up until now, you always had to live in close proximity to where you were working. So the bottleneck on growth and on resources has never been at the resource level. Resources are, for all intents and purposes, infinite. It is about using and utilizing and transforming those resources in a way that is cost effective, so that the end product is something that we get more back from it than we had to put in. And the reason why I say this is a belief or a myth that is keeping people poor is because it's the mindset that everything is zero sum, that everything is limited. In order for me to get something, I have to take something from somebody else. And this is just not the way growth is. This is not the way it's ever worked. If that was, how would we have 8 billion people on Earth who all have a specific amount of wealth? One person on Earth right now has more wealth than all of human history had just a few hundred years ago. That wealth didn't used to exist. Wealth is not a zero-sum game. It can be created and it can be destroyed. But if you think and believe that for you to be able to grow your wealth, you have to take from somebody else, then you will simply never be wealthy. But if you realize that you can only increase your wealth by creating value and giving more than you take or than you receive, that's when you start unlocking the key to getting rich. Because profit is the only true charity. It's the only true win-win. For an example of what I mean by this, let's say you go to the absolute best burger restaurant on Earth, In-N-Out, and you go and you buy your burger for $5. You give them $5, you get a burger in return. Now the question is, who profited? Some people say In-N-Out profited because they just made $5 minus costs. Maybe they made $1 or $2. The correct answer, though, is that both of you profited. It's not a zero-sum game. The reason why In-N-Out gave you the burger in exchange for the $5 is because they wanted the $5 more than they wanted the burger. So they got something they wanted in exchange for something they wanted less. You, on the other hand, you got something that you wanted, the burger, more than you wanted the thing that you gave away, the $5. And it wasn't that the burger was objectively more valuable than the $5. Otherwise, you'd be sitting there and thinking, well, I'm a fool. I should buy all of the burgers I could get. I should give them all of my available money because I'm getting something that is more valuable. No, it doesn't work like that. Those burgers are not objectively more valuable than $5. That one burger, or maybe two burgers, is subjectively more valuable than your $5 to you. But at some point, that next $5 is worth more to you than the next burger. A way to illustrate this even farther is, let's put ourselves back into a barter situation where, let's say I make cheese because I've got a cow, and let's say you make bread because you grow wheat on your farm. You've got a bunch of bread, but you want some cheese, and I've got a bunch of cheese, but I want some bread. So I give you some cheese, you give me some bread. Now we're both better off because now we can both have a sandwich, whereas before we only had one ingredient. Now let's say the next day I knock on your door and I try and make an exchange again. You say, well, I don't want more cheese yet. I still have some cheese. And I'm like, oh man, okay, well then what do you want? So now I have to go find something you want. Maybe I have to go to the apple farmer, give him some cheese, get some apples, so I can give you some apples so I can get the bread. And now those apples I'm accumulating simply because they are the middleman, or I should say the medium of exchange. They are the thing that solves what the problem called the coincidence of wants, where I don't want the apple, but I'm gonna get the apple because I know that then I'll be able to use that to get something that I do want. That's all money is. Money is that middleman good that people accept in exchange for things just because they know they can turn around and get something else that they really want for that money. And when you realize this, then you also understand that anytime there is a free, a voluntary exchange of goods, where one thing is being exchanged for another thing voluntarily, even if one of those things is money, both parties profit because they get something that they wanted more in exchange for something they wanted less. And to the extent that you can do that, you are making the world a better place because you're giving the world something that it wants more and more and more and more of in exchange for something it wants less of. Meanwhile, what they're giving you is something you actually want more of, which means when you understand how this works, the wealthier you become, the wealthier you're making other people. Profit is the only true charity. Myth number 9 is that volatility equals risk. If you go talk to any standard financial advisor at any financial firm, they're going to say, what is your time horizon? What is your risk tolerance? And the way that they define risk tolerance, when you say, well, what do you mean by risk? They're going to say, well, this investment in any given time period might drop 10 to 20%, but this investment might only drop 3 to 5%. And that is their definition of risk, that this one can move up and down quite a bit, and this one might only move up and down a little bit. They're conflating volatility with risk. These are not the same things. Volatility is simply the fluctuation in an asset, and it can be risky or it may not be risky. And in fact, some assets with the least amount of volatility can actually be the most risky because the lack of volatility is actually suppressing the true risk that actually exists there. As an example of this, look at any currency throughout history that has been pegged to an asset and then breaks the peg. There is no volatility for a period of months or years or decades, and then once the peg breaks, the value of the currency goes away immediately. The volatility spikes because there was suppression taking place so that there wouldn't be volatility, and that just allowed the risk to build up until the whole system breaks. On the other hand, assets that do have a good amount of volatility, you can actually use to your advantage, because simply by an asset being volatile means you might have an opportunity every now and then to buy it when it's undervalued, buy it when it's on sale, not because the asset is no longer valuable, or at least that's your opinion of it in the future, but because the market in that asset is very volatile. People are buying and selling it. The price is swinging wildly, which means you get now the opportunity to buy it at a price that is a discount. Not only that, but you can actually hedge against volatility. So just because an asset is inherently volatile doesn't mean that it is inherently risky, because that type of risk can be hedged using things like options. So volatility doesn't equal risk. What is risk? Risk is always defined as, or you should always define it as, what is the worst case scenario? Or in other words, what's the most I could lose? So if you put 10 grand into a stock, what is your risk? You're risking 10 grand. And the idea or thinking that the average fluctuation in that asset is the worst case scenario is foolhardy. It leaves you open to real risk, which is total loss. In reality, you can also hedge against real risk, which is total loss. Like we talked about earlier, by using things like options, you can also be disciplined. You can watch the asset price. You can have predetermined exit points based on fundamental analysis, based on value. You can even use automated orders like stop orders or trailing stops in order to get out if something happens. But if you have a true understanding of what real risk really is, then number one, you'll be more disciplined with your position sizing and with the assets that you choose to invest in. But number two, you'll be more savvy with how you actually hedge and mitigate that risk. Myth number 10 is going to be a very controversial one, and this one is definitely keeping many young people today poor, and that is the myth that you should not start a family until you are financially ready. And in my experience, what I've found is that most people who believe that will actually never be financially ready. Starting a family matures you like that. There's nothing that will grow you up faster than seeing your newborn baby stare back at you in the face and you thinking, oh man, how am I gonna provide for this? How am I gonna make sure that this little person has everything that they need? And I've seen it time and time again, even with people that I've known very well. As soon as they have a kid, responsibility goes through the roof. They start budgeting, they start saving, they start paying down their credit cards, they get better jobs, and it's also a much more meaningful life. And the fact of the matter is that we as human beings just simply become more of who we practice being, which means if you say, I'm not going to start a family until I'm financially ready, all you're doing right now is training yourself to live in a way that will never be financially ready. Your daily habits, your daily actions, and everything you do, you're training yourself to be selfish, to live for yourself. But voluntarily picking up the burden, the responsibility of starting a family will drive you to accomplish things you never thought you were capable of, far beyond anything that you would do with simply being driven by selfish desires. All right, I know I said there were 10, but I'm gonna give you a bonus one here. The 11th myth that is keeping people poor is that starting a business is risky. This is propaganda, again, that is pushed on people from the time they start school, because the entire public education system is designed to churn out employees. So the last thing that they want people trained to do is go off on their own, start their own businesses, and not be an employee. I've made a video about this in the past about the history of public education, but our entire public school system is designed, it is modeled after the Prussian public schools. Theirs were designed to churn out military cadets and soldiers. Ours was tweaked in order to pump out employees and people to work the factories. And it goes deeper than just corporate propaganda to have a cheap labor base. It's even deeper than that because who pays the majority of the taxes in America? Employees. And the public education system is run by who? Governments. So the whole purpose is to keep a tax base going. And in reality, jobs themselves are way more risky because you have no control. If your boss fires you, if your company decides to let you go, there's nothing you can do about it. If they decide that you're not worth the money that they're paying you, they'll say, we're gonna pay you less or bye-bye. There's nothing you can do about it. You can't control your income. You work harder, you do more, you add more value to the company. None of those things guarantee that you are not in control. Starting your own business is way less risky than being an employee. Especially nowadays with technology, most business startup costs are extremely small. If you're spending more than a couple $1,000s to start a business, you are definitely doing something wrong. Instead, what you need to do is start extremely small so you can market test your idea, start with one, see if it works. If and when it fails, you iterate, you change it, you try again. Try, fail, iterate, try, fail, iterate, try, fail, iterate. And over time, you'll get a little bit better and a little bit better and a little bit better. And every time you make a little bit more money, you can roll that in and keep on growing it. And you're in control. You're never risking a large amount. You're starting small, learning as you go and growing. And all the while, you're in control. Every iteration, every small failure gets you closer and closer to winning. Nobody is imposing an artificial income cap on you. Nobody else is telling you how big you can grow or can't grow your business. And nobody can just arbitrarily decide to take away your livelihood. Hope you learned something, and if any of this was helpful for you, there is a lot more where this came from. I run Heresy Financial University, where I teach people everything they need to know about making more money through investing and trading, limiting their risk, limiting their losses, growing your wealth, protecting your wealth. We got training material, we do live coaching calls, we've got a community, and I even have an asymmetric trade report that I send out that gives you opportunities for assets that are on the move. If you're interested in that, link is in the description below. As always, thanks so much for watching. Have a great day.